After a strong rally early in the third quarter, most of the gains were given back as stocks slid and yields surged after more hawkish actions from the central bank. So let's talk about the third quarter, our positioning, and also our expectations going forward here. So first off, this is going to be a longer video than normal. So if you prefer to read rather than listen to my voice for 10 minutes straight, which my wife can attest to is probably 9 minutes too long, I have the full transcript over on my blog. All right, so far this year, there haven't been many places to hide, with most asset classes participating in the market pullback. As you can see here on this chart, most are revisiting their year-to-date lows. So what's causing this to happen? Early in the quarter, we saw a huge bear market rally, only to really be derailed by more inflation worries. The Federal Reserve head, Jerome Powell, he came out and raised rate expectations for the remainder of this year and also revised growth and unemployment forecasts. The Bank of England also hiked rates, and really the misalignment of both fiscal and monetary policy is creating issues both here in the US as well as overseas. And this is because of fiscal splurge such as canceling student loan debt here in the US or subsidizing energy prices in the UK. Those are inflationary actions and may lead to even more hikes and poses risks of further rises in long-term yields as well as currency issues, such as we've seen with the pound appreciating and the dollar appreciating. Japan also intervened for the first time since 1998 to prop up the yen. This creates a problem because it causes yields to rise, and as yields rise, stock prices fall. Because the rate used in valuation formulas to discount those future expectations results in a lower present value today. So how much more will rates and yields rise, right? That's the question. Well, in this chart, we can see where the Fed funds rate target now sits by the end of the year, and specifically as it compares to past quantitative tightening cycles. Obviously, it's an incredibly quick pace that we've already set out on this year. And as you can imagine, there's a host of different opinions out there on this. And really speculation and sharing my opinion doesn't serve any purpose as far as if they're doing too little or they're not doing enough. Instead, I think we should focus on the things that we can control. So let's talk about the market backdrop going forward and what we can control because of it. Remember, the Fed has two mandates: prices and employment. So we're watching the inflation data here in the US, obviously, as well as in the Euro area, including the Fed's preferred PCE metric. For now, the Fed only seems to care about evidence that inflation is decisively on its path to a 2% target. So what are the things we should worry about? Number one, the Fed rate hikes aren't done as markets are pricing in at least two more hikes here in the fourth quarter. Two, inflation obviously remains much too high. Number three, the recession warning signs are growing. Number four, the number of companies that have started to issue negative earnings guidance are rising. Number five, the currency and bond market volatility has really gone through the roof. And number six, obviously, we still have the Russia-Ukraine crisis continuing. Now, all six of these things mean that our top priority for the fourth quarter is to stay focused on our long-term goals and avoid the impulse to get out of the market and abandon the long-term strategy. That said, I do realize that this isn't an easy task by any means, and we just need to remember that sound financial plans can overcome periods of intense volatility, but only so as long as we stick to the plan. So because of this, you're surely going to see headlines like unemployment starts to rise, home prices plummet, wage growth stagnates, corporations are freezing hiring. And my personal favorite, famous investor who called the 2008 crash issues warning. You need to remember that fear-mongering gets clicks and sells ads. So please expect to see a lot more of these headlines, to be very present every time you flip on the news. But remember, what affects the economy is different than what affects the stock market. Economic data looks in the review mirror, meaning it's a lagging indicator, while the stock market always looks out the front windshield, where it takes a story about tomorrow, how many Chipotle burritos do we think we're going to sell, and it assigns a price to it today. So let's assume that the Fed's aggressive rate hikes have already worked, hypothetically. Who's to say that the worst isn't already behind us, even though the real economy takes time for those hikes to trickle through? Now, I'm not saying that's true, but the question becomes, is the Fed going to slam on the brakes so hard that we go through the windshield, to kind of beat the car analogy to death here? So how are we positioned to combat those possibilities potentially becoming realities, in the next quarter and in the next year? So this year is one of the highest years on record with 1% or greater daily swings from day to day. This volatility is really due to the market attempting to price in those future expectations. So when we see these big up and down days, it means that there's a big range of what could happen, right? Both good and to the bad. So when I hear volatility, I hear opportunity. Rebalancing, placing tax trades, owning the right things in the right accounts are all ways to take advantage of this volatility. So specifically, this heightened macro volatility creates a stark trade-off for central banks at risk of over-tightening into recessions. So our strategic positioning is shaped by our view that central banks will stop hiking this year and not go as far as necessary to get inflation back to target quickly. Recent events kind of reinforce that conviction that they'll halt the rate hikes and live with inflation once confronted with some of the economic damage, either in the form of a recession or cracks in financial stability or even both. This would be much more favorable to equity than to bonds. So we're overweight domestic market stocks, and we prefer public to private equity. Inflation is going to persist. We prefer inflation-linked bonds to nominal bonds. All right, now that we've got the doom and gloom part of the video out of the way, let's talk about perspective. A lot of clients I've spoken with have relayed that this time feels different. And obviously, bear markets and recessions have happened before, with each being different for a different reason. So let's look at some data around this. This chart here reflects the bear market sentiment poll from AAII and the average 6-month gain when the poll sits at different levels. So last week, it eclipsed 60% for only the 5th time in history. So people are super bearish right now. But history says the more pessimistic the investor class becomes, the better the prospective returns look 6 months out. So here's where the paradox of investing exists. If I told you that compared to last year at this time, when people couldn't have been happier with the market and everyone was bullish, that 1 year later you'd be able to invest in stocks at a quarter less relative to their earnings, and a 1-year treasury bond would be paying over 4%, there would have been lines around the block like it's Black Friday. So why doesn't it feel like that now? Well, for everyone, this universal paradox, not just professionals, is that it's always going to feel the best at the worst possible time and the worst at the best possible time. Or as Morgan Housel stated, with investing, every past crash is viewed as an opportunity, like looking back at 2020 and realizing it was a great buying opportunity, and every future crash is viewed as a risk. So for those of you that missed out on 2020, you definitely said to yourself, I'm going to buy the next pullback. Well, it's starting to present itself now. But I realize that those emotions are still there. And at the end of the day, my opinion, real wealth is created during times like this. There's so much talk of a recession, and if we are in one. Now, this wouldn't obviously be the first time, so luckily we have some data to work off. Ben Carlson put together this chart reflecting the last 12 recessions. And the average stock market drawdown during a recession, going all the way back to World War II, is about 31%. So that's the average. Now, it could be definitely worse, of course, but it could also be better. Most important though is what happens after. So let's assume that we're either on the cusp of a recession or we're already in one. So first of all, we're already down almost 25% on the S&P. So we aren't starting from zero right now, which is important. We've done a lot of work this year pricing in that risk. So coming out of a recession, and this is where I want you to pay extra close attention, what do the 1, 3, 5-year, 10-year numbers look like? 1 year later, up 21%, which for any other normal 1 year does not look nearly as good. So coming out of a recession is like being a coiled spring. 3-year number, 48%. 5-year is a double, up about 94%. And 10 years after a recession, on average, you're up 256%, or about 3.5 times your money. So everybody wants to know, what's the story going to be that turns the market around? Well, the way that these things tend to work is that the market tends to turn around before the story does. And we want to make sure you're positioned to participate. So the reality is, again, we aren't at all-time highs. The stock market's doing its job and pricing in all of the headwinds and the litany of negatives ahead of us. It's much easier for me to make a video resuscitating all the negative sentiment you're already getting pounded with on a daily basis when you turn on the news. But the truth is, to survive this as an investor, you have to be able to do both. You have to say, hey, yeah, there's risks, and we want to build a portfolio that acknowledges those risks, but there has to be some benefits why we'd even be willing to take the risk in the first place. And that's harder to do than just listing all the bad stuff. So I've learned an important trick to managing perspective and therefore managing money is to develop foresight you need to also practice hindsight. And there's no perfectly reliable indicators, but buying fear generally pays off in the long run. So moreover, again, to the same point, hopefully one more comforting chart for you. If you go all the way back to 1996 and look at when less than 10% of the NASDAQ stocks are above their 200-day moving average, on this chart from Michael Batnick, which is where we are right now, there was never a negative year return 1 year later. Never. In fact, the average 1 year return later was up 35%. And obviously it's not a guarantee, but data like that personally helps me find that, comforting. And one final point is that if you invested 5 years ago in the S&P 500, which many of you watching have been investors at least since that time, those dollars you would have put in the market during, say, September of 2017 would be up over 58%, averaging almost 9.5% a year of growth, where we sit, at the end of September. Another positive takeaway, expected returns for bonds are finally higher than they've been in over a decade. A popular acronym over this last decade has been TINA, T-I-N-A, which is there is no other alternative, meaning cash bonds were paying so little that many investors had to take equity risks. So for those of you with cash on the sidelines, have, something worthwhile. The 1 year treasury is paying over 4% for crying out loud. So what should you do now? In short, control the things you can control. You can control your savings. If you're younger, it's counterintuitive, but we want the market to be lower for longer, enabling you to save more at these lower levels. You can control how much toxic news you take in, and you can control how you're allocated. Focusing on those things and not on the things out of your control is half the battle, just from a mental health standpoint, to survive an environment like this and really ensure that you come out the other side. So in closing, recessions are temporary, but your financial decisions during recessions have permanent consequences. Most, if not all, of your future value of your portfolio, as well as your mental health, comes from the actions that you're going to take during falling markets, not rising ones. Avoid big fear-based money decisions right now. I can't tell you specifically what to do because everybody's situation is unique, but I can tell you this. Don't make any knee-jerk reactions and jump off the boat in the middle of a stormy ocean. Storms do pass. I understand that many of you will be looking at another negative quarter on your performance reports. Please know that I'm watching things and that I'm obviously here if you want to talk. As always, we're going to stay on point, we're going to stay the course, and we're going to stick to our plan. Take care.